SoFi stock jumped 20% higher following their second quarter earnings update, then reversed course partially the day after as Wall Street firms, one in particular, downgraded SoFi stock, saying the valuation has overshot the fundamental earnings outlook, putting a $750 price target for SoFi. You look at SoFi stock, though, over the past year to date, it is up 150%. That's quite a nice gain for those that were buying near the lows. But if you look at their trajectory over the last few years, it's actually been a very bumpy ride over the last 3 years. It's just barely positive. So really, if you've made money, it wasn't from the hype and excitement during this SPAC era. It came from buying when it was bottoming out over the last year, and that you saw this 150% gain. One of those investors who was buying was the CEO, Anthony Noto, who bought several $1 million worth of stock, showing conviction. This is what I do like to see with my own personal investments. I want to find situations where management's buying in. So I do like to see this. This is one of the very favorable data points for looking at SoFi. And so in this video, I'm going to talk about whether or not that Wall Street analysts had any sort of merit to talk about valuation being, let's say, stretched. Where does SoFi stock potentially go in the years ahead? And what do I think about the underlying business? What's actually driving it? I apologize for my voice. I think I'm fighting either a cold or a family member got COVID, so who knows? But I wanted to bring this to you talking about SoFi. If you enjoy educational investment content, please make a point of hitting that subscribe button. Hit that like button. You're watching Unrivaled Investing. So let's dive right in to understanding what's going on here. So I asked AI Ticker Chat, you can see the link below, which leverages artificial intelligence to help research stocks. I asked, why could the stock be up on their earnings results? And it actually gave very relevant points that can quickly summarize what's going on here. They talked about a 37% year-over-year increase in financials, talking about their adjusted net revenue. That is very strong growth. Also, their 9th consecutive quarter of record revenue. So this consistency is one of the favorable things that investors like to see. Also talking about favorable fourth quarter adjusted EBITDA, a record level for them as well. I personally don't like the focus on EBITDA because there's a heavy emphasis on stock-based compensation there versus actual shareholder profits. And they also talked about raising their guidance for the year. So I do like to see a management that delivers on better and better outlooks over time. And so I got to give management, once again, a lot of credit. So not only, were they eating their own cooking and buying shares, but this is also a company that has consistently said, hey, we're going to do this, and they do even better. And so you see this with their second quarter guidance, where they said a range of 470 to 480 in terms of revenue. They did 489. Same thing with adjusted EBITDA. 50 to 60 million, did 77 million. So this is the type of behavior I like to see, and they are building a good reputation here. You do have to give them credit for that. And so I think when you look at their outlook for the year ahead, or for the remainder of 2023, which is about 30% growth, 17% adjusted EBITDA margins, which is predominantly stock-based compensation. That's one of the biggest components there. Looking at this, you could say, okay, maybe they'll do slightly better than that. Either way, 30% growth for them with reaching, EBITDA positive is certainly interesting. And they also talked about how they're expecting to get to GAAP net income positive by the fourth quarter. I really want to see that before I personally pull the trigger, but it looks like they might do it soon, later this year. So let's see them deliver, continuing to build shareholder trust. Why are they growing? Why are they doing so well? Partly because customers keep going to them. You see 44% growth in new members, working with the SoFi Bank platform. That's what you like to see. That said, this is still a piggy bank that's just oozing money. This is still a company that's still significantly unprofitable when you look at their actual earnings. And as a bank, you need to have real profits long-term to create value that can be reinvested in this business. This is not like a tech company where you can just run endless losses for year after year after year. This is a company that needs to build tangible value over time with their business, with their balance sheet. When you analyze and start peeling back the layers in terms of thinking about SoFi, really 3 different segments. You have lending, their technology platform, which includes Galileo, and financial services. Financial services is red hot, growing over 200%, 223% year over year. Lending, their core business, that's in blue over here, that is doing very nicely as well, up 29%. Technology platform, that was actually closer to flat year over year. So really the growth story is coming from lending and financial services. So what's that even mean? So financial services is really driven by a series of different products, more and more people using the SoFi platform, but also finding, hey, not only did I get my loan from SoFi, but maybe I want to invest with them. I want to use them as my investment platform, or I want to get a credit card through them, or I, use them for my, checking or savings account with SoFi Money. And they talk about, look, we can offer 4.4% for your banking options, saying this is way better than what you can get with, let's say, Wells Fargo or one of the mega banks that's closer to 0% for your savings accounts. I personally still use Interactive Brokers. I like them. It's a founder-led business yielding 4.8% on the available cash balances. You can see the link below. So I'm very happy using Interactive Brokers, which is, more attractive than the 4.4 you're seeing with SoFi. But when you're looking at, the different segments and what's actually driving the results, lending was the biggest and financial services was growing nicely, but really almost all of their profits is coming from lending. You got a little bit from their technology platform, and financial services, the losses are improving significantly, and they think that you could see that revert to positive by the end of this year. Okay, so these are the different data points. Really, you're looking at a lending company with some exciting stuff thrown on top. So where does SoFi go from here? First, in full disclosure, this is not financial advice. And I also, a quick plug, I recently bought more of a stock that I think is over 300% upside potential that I called out to my subscribers at unrivaledinvesting.com. So if you're looking to take charge of your investment journey with compelling ideas, market insights, and an exclusive Discord community available for annual subscribers, come check it out. That's unrivaledinvesting.com. I also offer educational courses. If you want to learn how to read financial statements or think about valuing a business, that's there as well at unrivaledinvesting.com. So thinking about what is SoFi? What do they offer? What is this business? Right now, it's really predominantly a personal loan company. Previously, the focus was on student loans. Now it's predominantly a personal loan business where folks are saying, hey, I want to get some sort of, maybe I need to redo part of my kitchen or something like that. And you can see that 80% of their loan originations are tied to personal loans. You can see student loans, home loans, so if you have some project that you want, tied, you could say, okay, this is it. This is 80% of the amount of loans that are going through their platform, and the average loan balance is around $24,000. So this is quite different than, let's say, a home loan where you're talking about a mortgage, or a student loan, talking about maybe a PhD program or a master's program or undergraduate. So here it is, personal loan, $24,000. That's the average balance. This is 80% of which of their platform, personal loans. And the reason why this is important to sort of call out is personal loans are a bit riskier. And as a result, you're generally looking at something that, has a higher coupon, a higher interest rate. They talk about the weighted average coupon rate being over 13%, nearly 14%. Student loans is closer to 5%. So, it's harder to pay something like this back. And as a result, you can see their assumptions around, a default rate of around 5%. Discounting these loans by about 6%, but you're looking at a niche player saying, hey, not all personal loans need to be super risky. We recognize it is riskier, but what we're going to do is we're going to charge a lot, and that's why they're getting that 13-14%. But we're going to target folks that have really good to excellent credit. And so the way to think about this business model from some of the key, slides that you've seen so far is you have a savings account that's above, let's say, the major institutions, where you get, instead of 0 at Wells Fargo or Bank of America, you're getting 4.4%. So you're getting a lot of deposits coming in. That's favorable for the SoFi Bank. And then you're taking that capital, which, keep in mind, that means your operating cost is going to be higher than Wells Fargo or Bank of America, because you're saying, hey, I'm going to offer something closer to a real market rate. But in order to make a profit, you're going to say, okay, well, I'm going to figure out these other ways or consider maybe riskier loans. And so that's where you're putting it into personal assets. So while a Wells Fargo or Bank of America might have a investment book that's predominantly mortgage loans backed by that physical land or backed by physical property, that personal loan backing on an individual, you're looking at something that's riskier. And so that's how they're making their spread on this business. And so you're sizing up that, okay, you're getting a lot of deposits. Deposits are flowing into the tune of billions of dollars because people want to get a return on their cash. That totally makes sense. People shouldn't be getting that 0%. And at the same time, SoFi's saying, okay, well, it's costly for us. We need to figure out a way to make money, make a spread. And so they're doing it by focusing on personal loans at this business. I think it is important to recognize here's a multi-decade chart going back to, I think, 1987 on the delinquency rate on consumer loans across all U.S. commercial banks. And it shows you that the delinquency rate is actually well below where it historically bottomed in previously during previous market, let's say, peaks. And so this is something to watch, because if you were to look at, let's say, during the dot-com implosion or the recession in the early 90s or the great financial crisis, you could be looking at a delinquency rate on consumer loans that's much higher than where we are now, which is under 2.5%. So my caution with SoFi, even though they successfully navigated COVID, you didn't really see that huge uptick in delinquency and consumers, sort of flatlining and struggling. And if anything, that's reflected in this low delinquency rate. So I personally want to see some variables like how do they navigate the delinquency cycle picking up dramatically, like we've seen arguably for decades prior. Could it pick up several percent from here, and what would that mean for their business? Could you actually start to see significant losses with the stock around where it currently is? You need to use the share count that's higher than what's you'll see on Yahoo Finance and stuff like that. I recommend you look up the term anti-dilutive. I've talked about this with my subscribers at Unrivaled Investing. Their market cap, I think, is actually even more than this. I was giving them the benefit of the doubt here, but this is around $10 billion in terms of the current value for SoFi. They've clearly grown. They've done a good job growing from, 400 million in adjusted revenue to around, they're guiding to around 2 billion this year. So they've done exceptionally well scaling this business, but we still haven't seen that profitability. And that's why I'm highlighting this, in sort of reddish pink or salmon, whatever color you want to call it, saying this is where the uncertainty with this stock is, because, and this is a key point, management says, hey, we're going to be profitable by year end. They talk about, and I used AI ticker chat, hey, call out all the different times management has talked about margins, and it listed management oftentimes talks about the 70-30 principle, where the 70% of their revenue is going to get reinvested, and they're looking at 30% incremental profit margins long term or more. And so you have this where they're not yet profitable, but maybe they will be at the end of this year, and really realistically break even, and maybe they can get to this 30% adjusted EBITDA margins, which truthfully, it's a huge amount of stock-based compensation. So saying, okay, what's the actual shareholder earnings? What's the shareholder margin that I should think about this? And so I, personally say, okay, maybe it's 10 to 20% long-term. And investors might say, hey, maybe it's realistically closer to 20%, at scale. We'll see how that, shakes out. If you think it's closer to 20 to 30%, then, you could say even greater upside than what I'm penciling here in terms of their pre-tax profit margins, looking at, this business and thinking about what this could look like over time. But I think in order for shareholders to have an attractive return, you do need to see 15 to 20% profit margins over time. And you do need to see 20 to 25% growth at a minimum over the next 5 years in order to have a really attractive or reasonable return from here. And that's just a conviction that I don't yet have, but I do like to see that management has it with buying the stock. And I do like to see management executing, with, better than expected guidance and performance, saying, hey, we're going to do this, and they actually overshoot. So overall, I do like to follow SoFi because this is an example of what seems like high quality management, and it seems like a business model that's developing. And look, if you really find a company that's going to, 10x, 100x over time. You don't have to get that first 100% or first 200%. You can wait for the story to unfold. And that's personally what I'm doing here. So far, you'd say, oh, Daniel, you've missed out on the last 150% rally, from the bottom. But I'm comfortable with that, with this type of company, because profits are so critical to a bank, and also partly because we haven't really seen how does this play out, this personal loan book play out if you actually have a real recession. So far, we haven't, fortunately. But if you do have a recession in the US, how does that play out for a riskier loan book like Sofi? Because right now I'm looking at this business model, and it's about higher costs than the big banks, but reinvesting it into riskier loans, which are these personal loans versus, focusing predominantly on lower interest rate, let's say mortgages, senior secured mortgage properties. You can blow up either way. Previously I did a video on Silicon Valley Bank, and they blew up because their deposit base could easily pull capital very quickly. And, they were, even though they were primarily investing in treasuries, think of how, low risk that is. But the problem is that those treasuries were super long dated. So every bank, this is the challenge with banks, is it's so easy to blow up either on the deposit side, the liability side, or the asset side, with, are you making intelligent loans throughout a banking cycle? And so, it reminds me of a quote from, I think, Charlie Munger. He talks about, in banking, they keep finding new ways to blow up when all the old ways work so fine. And I think I personally, based on seeing management buy, Sofi stock and seeing how they've executed so far, I would suspect credit won't be an issue, but it's just something I want to watch and see how they perform, over the years ahead. So far, the data points point to that they're managing it reasonably well. For example, in the most recent quarter, they were selling their loans at a profit, at above par value. So, they originate the loan, then they resell it for a profit. So far the data points are favorable, but once again, I want to see a full market cycle before I get super excited. At some point, I might even consider, buying a teaser position, just seeing that I like that Anthony Noto's buying stock, back for himself at low prices, and that he's building a reputation of delivering. So that's my take on Sofi. If you enjoyed this educational investment video, please make one of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.